Saturday, December 2nd, 10:14 a.m. New York time. Good morning. This is going to be a two-part video. So this is part one for YouTubers. Part two, just for my Patreon members. It's a comparison between the US dollar index and the 10-year yield, including top down. Part two would be in-depth charting and trade ideas with the stock ETFs to include as well. So these two grids, the left US dollar index is 3 years, each candle a month, and the right is the 10-year yield, 3 years, monthly candles. Again, the explanation of the US dollar index and the 10-year yield, they're available on my channel, detailing exactly what these financial instruments are, what they include. So looking here, US dollar index on the top left, this was the high of last year. On the grid on the right, 10-year yield, this was the high of last year. On the left, US dollar index, the high of this year. So the US dollar index this year did not take out nor retest the high of last year. Got it? But looking here, the 10-year yield, the high of last year here, where the 10-year yield made a higher high this year, that's a divergency. That's one of many divergencies you're going to see here. The low of this year here, US dollar, and the low of the 10-year yield this year. Or notice the low of both of them here. Lows are both inside the range of last year. Whereas the US dollar, even the high of this year is inside the range of last year. Whereas the 10-year yield is now back inside the range of last year. Slow correlation, but catching up. And now they're caught up. They're both inside the range of last year, leaving bearish bias. The US dollar index for the current month, which we just had one trading day so far, that was Friday, 7/1st, of the monthly candle, inside candle for the US dollar. So the US dollar has not taken out the high or low of November yet. Whereas the 10-year yield already broke below the low of last month, November. More bearish bias. US dollar index, November, look at that big candle, big red candle, almost a solid body, very big, above average size than all these other ones. Same with the 10-year yield, big red candle, huge trading range. And look, all these green candles here, big red ones. So there's a correlation. They both had huge panic selling, dumping in the month of November, meaning bearish bias. And then if you count back 3 candles on each of these, the December one here, November, October was the high of this year. October, US dollar was the high of this year. And the 10-year yield, October was the high of this year. Correlations. Look that over. Watch that for a second. I'll come back. Gotta get some water. Stay hydrated. Drink water. Sip cup. Well, the correlation here again. Which one leads the other? Well, we know the US dollar is a safe haven currency worldwide among the other two, Swiss franc and Japanese yen. We know the central bank, United States Federal Reserve, controls short rate interest rates overnight to affect the yields. Higher interest rates strengthen the currency, and vice versa. Lowering interest rates weaken the currency. So many countries that have central banks, that are free markets, have this effect. Again, every country has some kind of financial instrument they call their currency. But again, some are not, let's just say, up to par, being credible to buy, hold, and trade with. Thank goodness there are credible ones better than other ones. They're inside this index. Going back in here on the US dollar index, here's the low of the year, here's the high of the year. Zoom in a little bit more. Well, at the beginning of the year, we had this huge consolidation, overlap candles. Then we had a low here, that low of the year. Notice here on the 10-year yield, it had a consolidation, but didn't break below that consolidation like this US dollar. So again, building consolidation, building calls for energy to break out, which it did. 10-year yield broke out to the upside. US dollar broke below and then corrected itself and finally broke above this consolidation. So again, there's always that one kid, or maybe more, in the school that's slower than the other ones, or not paying attention when you all go in one direction and finally realizes they're wrong. Let's go with the class. That's what happened here. And you notice also again, this is a shorter trend. This trend was much more defined, a lot of green candles. The high of this year, US dollar, was a red candle, huge wick on the bottom, blow off top, almost like blow off top. But such a fake out here, because again, this trend almost had a hangman, but it wasn't a solid body on the top. Whereas this candle on the top, 10-year yield, was almost a solid green. That being said, this was looking more bullish, this candle up here. This was looking very bearish. They were divergencies. And one could have been looking for a trade short on the break below this, because both these red candles broke below the candles high of the year for trade signals. And then they had these huge dumps, huge panic sells. Got it? Then on the bottom here, at the top here, I have the Fibonacci. The US dollar last month in November did a deep retracement, tested the 0.618 and bounced off of it. Deep retracements of 0.618 are bearish bias, has a probability of less likely taking out this high. So one would expect you're going to get some kind of retracement to the upside. I already labeled midpoint there. And that retracement on the upside, one should be looking for bearish trade entries. Looking here on the 10-year yield, bottom, high, Fibonacci. All it did was break below, close below the 0.382. So the momentum's still on the downside, but it hasn't done a deep retracement yet. Let's take it to the intraday, on the weekly time frame. Pause for a minute. So here we go on the weekly. I want to zoom this out a little bit more. Three years. Each of these 3 years, each candle's a week. Again, identify US dollar, the high of last year. The 10-year yield high to last year. So the high of the last year here in the 10-year yield, that purple horizontal line. And then that tested it, rejected it, went down, went above it, high of the year, dump, broke below it. So notice the correlation here. Zoom in some more. Zoom in some more. Fibonacci on the weekly also came down at 0.618 here and bounced off of it. I labeled the midpoint of that candle right there, big bearish candle. I labeled that one too, midpoint that candle, midpoint that candle. So this purple horizontal line, maybe we'll have a retest up there looking for a trade idea for trading bearish. Again, they're both bearish. Multiple time frames I'm showing you. One should be looking for those bounces to be trading bearish. Zoom out a little bit more here. Lower the year, lower the year. Multiple tests here on the low of the year 10-year yield. We have a swing point here on the US dollar index here. Again, we know the momentum's to the down and the weekly's to the down. Go to the daily chart. Zoom in some more. High of the year, US dollar, high of the year, 10-year yield. Here's the difference. Blue horizontal line, the August low, swing low, broke below it, closed below it, reversed, popped up, and tested midpoint in this area, consolidation, rejecting it. Again, that was consolidation. Swing point broke below. And again, looking for that entry on that reversal that filled. Well, here, with this August low, again, we have August lows on both of these. They both broke. This one broke sooner, several days ahead of time. Where the 10-year yield did it on Friday. So again, we have this currency cap happen earlier. And if you missed that trade, well, here was that trade here. So we already know the US dollar popped here, filled and trending lower. So I want to expect maybe this is going to bounce up and looking for that opportunity, trade short. Well, it occurred. Yep, it occurred. Because even though we didn't take out that swing low here right away, we had this consolidation break below it. And you had that green candle retest, rejected that midpoint. See that big wick, rejected it. And the next candle is it went lower. So just because they both have the swing points, zoom out a little bit more. These swing points, yes, we knew on the downside potential targets they were going to, but the trade signals occurred differently. They said this retracement filled earlier before it did that swing point. So again, nice comparison on both of these. On opportunities, if you catch one sooner, great. If not, here. And let's take it to the intraday on the 4-hour. Top left. Put on 4-hour candles each. Let's put it for 10 days. That's the US dollar for 10 days. And the 10-year yield for 10 days. Intraday. 4-hour candles. So if you want to do this for day trading or swing trading for shorter durations, swing trading that might be for 2 days, 5 or 7 days. Again, these 4-hour candles, blue horizontal line here. US dollar was the high of last week. And the high of the 10-year yield was here. Let me put that back up there. Prior week high. Here we go. Oops, bring this back a little bit more. Good enough. Okay. So when this occurred, the high here, look at that, nice big green candle, big wick on the top, rejection, and sold off, dumped. Tuesday, Wednesday this week, the US dollar did a consolidation. Again, that was a big dump. That was a high dump, consolidation, pump, consolidation. Again, we knew this was bearish. You had consolidation here, big red candle, engulf this. That's a bearish engulfing candle. Big red candle engulfed all those, top of a trend. One could be looking for trading short in the break. Yep, that's sure right there. Nice break. Same thing here in the 10-year yield. Broke above this high of last week. Small little consolidation and then the dump. Retracement, consolidation, dump. Huge panic selling on this candle, that 4-hour candle versus this one. But again, they both broke below the consolidations. And you notice on the high this week, that prior week, don't forget the prior week was shorter because Thanksgiving. You had that inside candle after the high of the week. And same here. On the high that went up here, that occurred after the high of the week, a few days later. Inside candle, that 4-hour candle. Zoom in some more. Nice trade signals on the top of these highs. Inside candle and the reversed. Correlation in both of them. Nice. Then looking here, this consolidation of 4-hour candle occurred at the end of that Thursday, into that Friday. Same thing, Thursday, Friday. Had several hours overnight, morning sessions to look for these. And trade signals, breaks below them. We're trading bearish. One could have done that. Trading overnight, close in the morning, whatever works for your time frame. So zooming out a little bit more, you should identify that correlation. Low of last week was here. Let me label that. That was the low of last week. Week that just passed. Let's see correlation in a minute. Yeah, last Sunday, all the way through the week, prior week low. We were above the prior week low of the US dollar, right? And then let's look at the high of the week. So we had Sunday here, Sunday dumped. So again, Sunday, the high was there, but the week of this past week is here. This week's high, past week's low. Versus here, look at that. 10-year yield already this Friday made the low of this week. Much more bearish than the dollar, but they're both bearish. So let's label this. So come next week, I already have my inside setup charts. And the high this week, well, Sunday night it opened. So I'm going to remove the last week. It's not valid anymore. And Sunday night occurred here. Was that Sunday night? Yep. So that would be the high. Let's double check. Yep. The high session there. Keep that as purple. Prior week high. So I'll begin looking for trading bearish opportunities, looking for the pops, potential trade ideas. I don't want to catch a falling knife on either of these, so I'll begin looking at multiple time frames for the bounces, retracements for opportunity to trade shorts on intraday. Look at this. Let's see what happens with this midpoint. So again, the momentum could continue going down maybe on these. And that's what I'm not looking for the entry. I'm looking for that pop, such as this, trend down, retracement, consolidation, breakdown. There's always another trade. You miss one, you can look at the other one. You miss both of them, there's always another trade at the higher time frames, intraday time frames. That's it for this video. Thanks for watching.